Kicking off a new week with the big question, how much runway does this bull market have left? Darius Dale is founder and CEO of 42 Macro and joins us now. Darius, great to have you on.
It's a real pleasure to be here. Thanks for having me, Caroline, and happy 250th to you and your family.
Thank you so much, and to you. So Darius, we have the Dow sitting near an all-time high, the S&P 500 not too far from it, and a lot of investors wondering whether they're too late to this game. Based on your macro work, are we still early in this bull market, or are we getting closer to the later innings?
Well, that's an excellent question. I love that you posed the sort of inning question because I think we're a lot closer to the seventh inning stretch than I think the median investor realizes for a couple of reasons. One, we think the markets will eventually have to transition to price in peak or transition from pricing in peaking inflation to ultimately sticky inflation. And we think that transition is ahead of us over the next 1 to 2 quarters. And then secondarily, you're getting a lot of signals from the market itself to the Mag 7 companies, to a lot of the AI CapEx spenders to perhaps throttle down on the rate of change, on the acceleration of all that CapEx. And if they do that, then it's likely to have a negative impact. It's going to ripple through financial markets negatively in terms of revising down sales and earnings growth expectations. So that's kind of a 1-2 punch that we see as developing market risk over the next, call it 1 to 2 quarters. But ultimately, we don't think this is the ninth inning. We don't think the game is over. We think the 42 macro paradigm C bull market has legs into and perhaps even through 2027.
Okay, but let's talk about what pricing in sticky inflation could mean for where this market goes in the next 1 to 2 quarters.
Yeah, look, I mean, we've been coaching our global investor community to anticipate something like a summer of 1998 style market dynamic. We don't want to be too specific on, the magnitude and the timing because in our opinion, we think market timing is for newsletter writers. We are serious institutional investors here at 42 Macro in terms of trying to keep our clients on the right side of market risk. But just kind of looking at that, 1998 example, we saw that the S&P 500 rallied about 20% in the first half of 1998. We were obviously in the full throttle tech bubble back then. But then ultimately, as we saw some of the issues develop with Russia, the default, and long-term capital management, we ultimately saw the market pull back about 20%. We eviscerated the entire up 20+% year-to-date return, but then ultimately the Fed started cutting interest rates and easing monetary policy to offset some of those macro dynamics, and then ultimately we had a very, very vicious rally off those lows in August into year end, and so we ultimately finished up plus 29% in 1998. But this is inclusive of a 20% rally, a 20% crash, and a vicious V bottom after that. And so we're expecting something similar.
Okay, so help us wrap our heads around that. We're up about 10% year to date in the S&P 500, only about 1% off all-time highs. So you're expecting a correction before year end, but then ultimately you think we'll end this year higher.
Yeah, ultimately. So what we've been exactly, and that's a great way to characterize it. We've been essentially saying the Fed needs to play action pass to set up the run. And if you think about what the passing does, is it a lot, regaining a little bit of credibility on inflation fighting would go a long way for the Kevin Warsh Fed to allow for this, this AI CapEx build out to continue in a way that doesn't drain resources and tax the productive other sectors of the economy in a way that pushes up overall the general price level in the economy. And so they ultimately need to regain a little bit of credibility on inflation fighting. What we've been saying is back the safeties and the linebackers up. That's the bond market. Essentially get the bond market on board with, this is a Federal Reserve that is serious about its 2% inflation target, that's serious about its price stability mandate. But ultimately, where we think this is all headed, and this is why we don't believe the bull market is over, is when you look at the 5 task forces that Kevin Warsh laid out at the June FOMC, the communications task force, the balance sheet task force, the data and the data task force, the productivity and jobs task force, and the inflation task force. The net result of those 5 task forces, in our opinion, based on our deep understanding of the data and all the critical variables and how they connect together, in our opinion, we think the net result of those task forces will be very dovish on a net basis. Not every single one of them. We don't think the balance sheet is going to be positive. We don't think the communications task force will be positive, but the net result is likely to lead to a much more dovish monetary policy and a dovish reaction function starting in like late 2026 or maybe even early 2027. And if that is true, you can't go from peak inflation to sticky inflation to dovish monetary policy. They're going to have some sort of intermission there that sends a message to the bond market that they're serious about inflation.
Okay, so the market needs to price in this sticky inflation. Do you think the market also needs to price in rate hikes then, or no?
Well, we've been of the view that rate hikes are the wrong tool to address the current drivers of inflation coming out of the economy. We know that the bottom of the K, whether it be the consumer sector, whether it be the business sector, and ultimately whether it be just generally interest rate sensitive sectors, the bottom of the K in the economy, if we're being honest here, is still in recession. When you look at real consumer durable goods growth, when you look at residential fixed investment growth, you look at non-residential fixed investment growth and structures in particular. You look at delinquency rates for credit cards, auto loans, student loans. Those are essentially at or near levels that are consistent with the height of the global financial crisis. Right now, on an aggregated basis, delinquency rates are consistent with where we were at the trough of the Great Recession, and so that tells you that there's very clearly a downturn going on for the households and the businesses on the lower end of the K-shaped economy. So using the policy rate tool, in our opinion, would be a mistake because all you're going to do is exacerbate the downturn that we're seeing in that segment of the economy without actually addressing where the inflation is coming from. Because obviously, if they're in recession, they're not the contributors to the inflation. Where inflation is coming from right now is three main vectors. One, we obviously have a massive aggregate demand shock from AI CapEx. When you look at the roughly $800 billion of hyperscaler CapEx that's expected for 2026, that's about 2.5% of US nominal GDP. The $1.2 trillion that's currently projected for 2027 is about 3.6% of nominal GDP. I mean, this is nuts. I mean, I don't have another word to say this. This is insane how big the massive aggregate demand shock this is from the perspective of the economy. So that's one. The other two vectors are policy driven and monetary driven. On the policy side of things, we have growth and deficit spending tracking about 8-9% year over year. We have the Fed's rate of change, the annualized rate of change, the Fed's the monetization of U.S. public debt, because again they're still doing reserve management purchases. That's somewhere around 6 or 7% year over year, and then you have bank credit growth growing at about 7 to 8% year over year. These numbers are incredibly inconsistent with 2% inflation. And so ultimately, we know that all that's kind of really going to and being driven by the top part of the K-shaped economy. And so the Fed, in our opinion, would do a much better job of targeting this current level of inflation, these current inflation pressures, by using its balance sheet, first by ending reserve management purchases, but ultimately reinstating quantitative tightening and threatening to do even more of that heading into the fall into next year, which will ultimately, in our opinion, give the bond market some comfort that this is a Federal Reserve that is serious about inflation.
Yet you're bullish. So you aren't necessarily painting the picture of a bullish landscape, especially since in addition to that, you said companies might start throttling down, I think you said, on CapEx. So give us the reasons that you think that this is a market that can continue to run higher.
Yeah, well, we don't think ultimately the Federal Reserve is going to end the AI CapEx bubble. So that's unlikely. If we did the market, in our opinion, we think the market would ultimately reward some discipline by the capital spenders, the CapEx spenders, because ultimately what we're seeing from the end user data is that they're no longer burning tokens, like it's going out of style. They're the companies that they're selling the compute to in the real economy are actually throttling back their usage because they're not seeing the advent of productivity growth as quickly as the CapEx spenders would probably like. And so ultimately we think the market will reward that discipline because it'll ultimately elongate the process. As long as you elongate the process and don't end the process, then you still have an upward sloping earnings curve, which albeit maybe having to get revised down a little bit from a rate of change perspective, but ultimately it'll settle out in a still, uptrending, expectation from the perspective of earnings and sales growth. So, the micro side of the story isn't over. We know we're going to be, spending 8 perhaps, even higher than $1 trillion in CapEx between now and 2030. We know there's a lot of money that needs to go into the ground and from a picks and shovels perspective. So this AI build out is not over. And more importantly, as we said earlier, the net result of the 5 task forces, if we think we're right, obviously we think we're right on this. If we're right on that view that it's going to be dovish, then the markets are going to have to price in a significant amount of right to tell risk starting, in our opinion, our current expectation of when they outline the findings of the task forces is in the December FOMC. And so if they outline a very dovish monetary policy outlook for 2027 at the December FOMC, then the market's going to have to price in a significant amount of right tail risk. And that's how you have a significant upcycle in 2027. And I think the markets will bottom well ahead of that because the markets are forward looking.
Okay, so we saw chip makers struggle last week. Do you look at that then as a healthy reset, or a crack in the AI trade? And if leadership broadens from here, where should investors be looking next?
Yeah, that's a great question. So it's a healthy reset. It's an appropriate crack. It should be cracking. I mean, again, we were the expectation heading into last quarter was that AI CapEx was an asymptote that was just going to keep going higher. And in our opinion, we think that is no longer true. That, at least according to the median investor, that is no longer true. So ultimately, the investors have to migrate to a understanding that trees don't grow to the moon. We're not going to be able to just ratchet up AI CapEx indefinitely because ultimately we're not, the cost of all this compute from the perspective of the businesses that are using the service, using the AI, the cost is not yet justified by the expansion in productivity growth. And we think it ultimately will be justified, but there's a mismatch, there's a timing mismatch that needed to be reset. And so in our opinion, we're in that reset process. But ultimately, in our opinion, where we think this is headed longer term, and this, in our opinion, we think this trade has a lot of legs from an x-axis standpoint, is our source of funds thing. We've been of the view since last fall that investors should use the Mag 7 companies to capitalize as a source of funds to capitalize other businesses, particularly other businesses down in cap and out across the geographic borders. You think about the mid caps, for instance, here in the U.S. or international stocks by and large. They've been left for dead from a valuation perspective. But what ultimately is going to happen is AI, this technology, is going to diffuse across cap. It's going to diffuse across borders, and it's ultimately going to cause a compression in the relative spread between Mag 7 companies, productivity, margins, and earnings with everyone else. And that compression, in our opinion, is likely to lead to a compression in valuation between the Mag 7 and all the other businesses and companies. And so we've been instructing our global investor community quite successfully since last fall to use the Mag 7 as a source of funds to capitalize everything else. And as we can see, everything else is demonstrably outperforming.
And just to clarify, using the Mag 7 as a source of funds means trimming profits from the Mag 7 and buying basically the S&P equal weight index.
S&P equal weight, mid caps is a great segment of the market to be focused on. International equities is a great segment of the market to be focused on. I mean, there's been a significant compression in the relative productivity, the margins, as well as the earnings expectations between U.S. markets and international markets. Cap weighted U.S. markets relative to uncap weighted markets. We've seen the compression in the operating metrics already, and in our opinion, we believe this technology will perpetuate that compression and perpetuate the improvement in operating metrics for some of these companies that have been left for dead from a valuation perspective. But what has not happened yet, in our opinion, to a significant enough degree, is the compression in valuation. In our opinion, we think that compression in valuation has legs from the perspective of the next at least 1 to 2 years, perhaps even much longer than that.
But do you still want exposure to the Mag 7 at all? And what about those investors who maybe aren't Mag 7 heavy, but they're S&P 500 heavy? What do they do?
Yeah, what in our opinion, so we want Mag 7 exposure at all right now because again, they're eviscerating their own free cash flow. Now, if they finally get some discipline, if the market gives them discipline, if they get discipline from the market to slow down that rate, then maybe they become an attractive buy from a valuation perspective. But again, just as an investor, you want to skate to where the puck is going, not to where the puck has been. And so what we're essentially telling you and have been telling our global investor community since the last fall is the puck is going elsewhere. The puck, you want to go chase the new earnings growth. Go find the new free cash flow growth. Go find the expansion in gross margins. And it's not Mag 7, it's other companies. It's the companies that are going to adopt AI to increase their productivity. It's the companies that are going to adopt AI to increase their profitability. It's the companies that are going to adopt AI to increase their earnings expectations. And we've seen this movie before. We saw it in the equities market going back to early 2000 when China joined the WTO in 2001. They gave China access to a unified global market, much like AI is this unified technology that creates productivity for most businesses, at least service industry businesses. And so we saw China outperform U.S. markets by about 500 percentage points from the time they joined the WTO to the middle of the 2000s. And that's exactly that's the kind of technology transfer, open market access that we're essentially calling for going down in cap here in the U.S. and across our geographic borders to international stocks. We saw this movie before in Europe as well. You go back to the Maastricht Treaty, which was signed in 1992, which was the creation of the euro. From the time the treaty was signed in 1992 to the time the euro was officially adopted and introduced in 1999, we saw a massive compression in credit spreads across all the peripheral countries in Europe. For example, Italian BTPs, they're trading about 700 basis points above treasuries, whereas German bonds are about, on par with treasuries. We saw that entire 700 basis point spread compress to where the German boom was because of the adoption of the single monetary policy, the common monetary policy, the common currency. And so we're essentially saying AI equals euro, AI equals open access to the international markets, much like in China's case. And so, if that is true in terms of the source of funds theme, this convergence expectation, that's going to last for years.
Okay, so for those investors who are heavily exposed to the S&P 500, they need to be making some changes as well.
Yeah, in our opinion, yes, absolutely. Yeah, we don't. Again, this trade has legs. The valuation alone will tell you where investors are crowded in terms of their positioning. Investors are crowded in all these names that have worked for many years, and appropriately so. This is where the cash flow growth was. This is where the gross margins were. And we're essentially saying that on a relative basis, the cash flow growth and the gross margin expansion will not come from these companies. They will come from other companies going down in cap, mid caps in the US, and go international equities abroad. And you don't have to be specific a sector. You don't have to pick stocks in this trade. This is a long-term structural macro tailwind if you're in the right exposures, going down in cap, equal weight, S&P, international. This is a long-term macro headwind if you're stuck being, allocated to things that, everyone that if you stuck to yesterday's trade, if you're stuck allocated to yesterday's winners, then your portfolio is going to perform like you're stuck allocated to yesterday's winners. And that's what we're trying to coach our investor community to offset.
And then just quickly, if you still want exposure to the AI trade, then how do you get that if you aren't getting it through the Mag 7?
If you want exposure to the AI trade, so obviously the picks and shovels have been working. The semiconductors trade was working. We're in a risk-on reflation market regime, and that's exactly what you would expect. High beta, growth, technology. These are the types of things that work in risk-on market regimes, which our market regime nowcasting process has signaled we've been in since April 11th. And so, since April 11th, our global investor community has been going further out on the risk spectrum, chasing higher beta equities, more cyclical exposures in the equity market, going down and going further out on the risk spectrum in the credit markets. And that's exactly the kind of behavior you want to take as an investor to maximize upside capture in a risk-on reflation market regime. We're essentially arguing, going back to the beginning of our conversation, Caroline, is that we're essentially saying we might be nearing the end of this reflation market regime. I'm not, we're not going to be specific on timing because that's, again, we don't market time, we don't predict. We're just, we're fast reactors. We're essentially saying the distribution of probable economic policy market outcomes is likely to evolve. It has been evolving, and it's likely to continue evolving in a negative manner. And if it evolves in a negative enough manner, then we're going to have a massive disconnect between being in a risk-on market regime and having a lot of left tail risk to price in. And so right now, that spread, that awkward, kind of disconnect has gotten increasingly awkward in recent weeks. And so at some point in the next 1 to 2 quarters, we're expecting it to be so awkward that the markets actually have to price in a risk-off market regime that looks something like summer of 1998. And so that in our opinion, is a reasonable probability outcome. And if that's true, then you have to be, dispassionately execute any risk management process that tells you to, take down risk, to come in on the credit spectrum, to go up in cap, to, to take a little bit of risk off the table, to give yourself a better opportunity to buy what we ultimately think will be a very viable dip at some point this summer or this fall.
Okay, and just digging into that a bit more, it has to be quick because we're just about out of time, but if we do see that play out, if we do see kind of this pullback that you're expecting within still a bull market that can charge higher, how should investors actually respond? Should they buy any dips? Should they take some profits, or should they just stay the course?
In our opinion, we think when our system says, it's time to head for the exits, it's a risk-off market regime, you need to be reining in risk. You need to be coming in on the credit spectrum. You need to be going up in cap. You need to be taking down the beta of your overall portfolio, maybe even raising a bit of cash to the extent that, that's what our KISS and Dr. Mo signals are signaling. But ultimately, what we're essentially coaching our investor community to saying is that is likely to be a transitory outcome. If that outcome occurs, then it's likely to be a transitory outcome. In our opinion, we think what would cause the outcome to occur is the Federal Reserve trying to, create a little bit of more credibility, a little bit of scope to ease monetary policy more significantly later in the year by tightening more than what's currently priced in at the current juncture. And if that doesn't happen, then it's unlikely we have a material enough correction to warrant taking down risk. And if that does occur, we're going to continue to rally, and we're going to have an inflation problem in 2027.
Okay, so if the Fed decides to hike is when you might change your bullish tone.
No,
am I
no,
getting
no.
that
We
right? No.
Yeah, no, we run very sophisticated quantitative algorithms to tell us, what to do in financial markets. None of our fundamental views have any impact on my or our investors' portfolios. So, what I'm essentially saying, I'm predicting the predictors, if you will. I'm saying I think
Okay.
the algorithms are going to tell us to take down risk in the future because of these fundamental dynamics. If we're wrong on those
Okay.
fundamental dynamics and the algorithms don't tell us to take down risk, then we're going to continue to bubble and ultimately have an inflation problem in 2027.
Okay. All right. I think this is a great time to transition to our rapid fire game of this or that.
Let's
Quick
do it.
questions, quick answers. Are you ready, Darius?
I love it. This is awesome. I love this segment.
All right, here we go. Second half, risk on or risk off?
Both.
No hedging.
Both. Risk on
Just
first half of second half. Risk off first half of the second half. Risk on second half of the second half.
stocks or bonds?
Stocks.
Individual stocks or ETFs?
ETFs.
US or international?
International.
Large caps or small caps?
Middle caps. Mid caps.
Equal weight or market cap weight?
Equal weight.
Mag 7 or the rest of the market?
Definitely not Max 7. Rest of the market.
No surprise there. Healthy chip reset or AI cracking?
Healthy chip reset. AI is not cracking.
AI spending boom. Are we in the middle of it or near the end?
Middle.
Broadening market or AI still leads?
Broadening market, but AI probably anything tethered to AI will continue to lead, in my opinion. That's where the earnings growth is.
One sector that's just getting started.
Ooh, I love this one sector that's just getting. Everyone keeps trying to buy healthcare. I don't have a real strong view on that, in our opinion. But if we go into a risk-off market regime, investors are going to want more defensive, lower beta plays, and so healthcare is a sector that could potentially pick up some relative flows in that scenario.
One sector that's fairly valued here.
A sector that's fairly valued here. Technology.
Next 12 months, buy the dip mentality or play it safe?
By the dip.
Economy, resilient or overheating?
We invented the resilient U.S. economy theme in the summer of 2022, and we see no change to that view.
Inflation, cooling or sticking around?
Sticking around. That's the biggest misnomer in markets right now. Markets are focused on peak inflation, appropriately so. We think 1 to 2 quarters from now, they'll be very much focused on sticky inflation and the lack of progress towards 2%.
Sticky inflation at what level?
Close to 3.
Higher for longer rates or rate cuts?
They'll be cutting rates a lot in 2027 if we're right on the task forces.
Recession in 2027, yes or no?
Oh, no, God, no. Our economy's going to go 3% just from AI CapEx alone. Absolutely not, no.
One word to describe how you're feeling about the market for the rest of this year.
Sanguine.
Darius Dale, founder and CEO of 42 Macro. Thanks so much for playing along. We really appreciate your insights as well.
Appreciate you, Caroline. Thank you for having me. I look forward to next time. This is great.
If you enjoyed this Street Talk, check out our full conversation with Frances Newton-Stacy. She breaks down how AI bottlenecks are reshaping the market and what to do about it now.